Hello, welcome back. I'm Danielle Kosick, and let us be the first to say happy holidays to all of you. 2023 has been a much welcomed reprieve following the year the market had in 2022. Today we are joined by Rob, Matt, and Jason for them to provide insight as to what we were able to accomplish this year and what they see as future opportunities coming in 2024. I know I'm pretty young, but I know enough about history to be able to make the statement that these are some unique, if not unprecedented times. What is DLAC seeing, and what actions will my advisors be taking?
Danielle, it's a great question. But before I get into that question, I do want to first say, can't wait to have you back here in Ohio for Christmas. Secondly, to all DLAC clients, a very happy holidays, Merry Christmas, and Happy Hanukkah. Back to the question. Well, in unprecedented times like these, you might expect me to trot out one of my favorite Warren Buffett quotes, but you'd be wrong. My go-to quote, and pretty much any day that we talk about my investment philosophy and how I go about investing dollars, is from the most, I wouldn't just say the most famous, but the greatest hockey player of all time, Wayne Gretzky. As a great one once said, skate to where the puck is going, not to where it is. Sure, he was talking about scoring goals, but from an investing perspective, it underscores my greatest responsibility to my clients. Rather than focus my attention on where the market is today, I will always look to tomorrow. Or as Wayne might do, I'll head up the ice while others track the puck in a crowd of skates. I bring this strategy up because my intent today is to show you how it really has produced a significant benefit to DLAC clients across every major investment theme that we've undertook over the years. Also, as to how I see it, things as they're going forward, and to the decisions that this may lead to. And I can give many, many examples, but it's time after time in terms of what I do. I just watch my peers become engulfed of the investing theory or energy of the day. You know, it's been this way all 30 years that I've been managing money. Is yesterday's winners often, if not always, will be tomorrow's laggards. So investing what is hot today will often, if not always, be a loser strategy.
You talk about skating to where the puck is going. Can you provide an example where DLAC clients have benefited from such?
Danielle, as pertains to that question, I can't help but think back to the beginning of DLAC. I got to learn at that point in time that there were so many people in this industry that were not even familiar with what an ETF was. And just bringing up the concept of its inexpensive and extremely tax efficient nature just was bringing out such positive responses of peers of mine who were not as intimately involved in the investment, part of this industry. If you as a client have been working with us for at least 10 years, you'll probably remember back that a significant part of our initial meeting was probably spent explaining what an index ETF is and why I would be using them instead of active mutual funds, which a majority of my peers at the time were investing in. In 2005, the year that DLAC started, there were 80 ETFs, and those ETFs had about $300 billion in assets. Today, there are 2,700 ETFs with $7 trillion in assets. I guess the rest of the industry threw in the towel and decided they were going to have to give up all the free stuff from their mutual fund wholesalers and start to put their clients first, to now using much more of a tax-efficient and cost-conscious solution.
I know DLAC has been proud of the work that has been done for its clients in the recent past, but can you give me an example of something DLAC has done within the past 18 years that has made most, if not all, clients wealthier?
All right, for you, Danielle, 18 years ago is too far back. Well, you're just a kid. So if I'm going to use a much more recent example, most of you wouldn't know it, But according to the Wall Street Journal, 2022 was the worst year in 75 years for the 60-40 investor. What's a 60-40 investor? A 60-40 investor is an investor who has 60% of their monies invested in stocks and or the S&P 500 and 40% of their money in bonds or the bond index. All right, so it was the worst. You're probably asking yourself, was it? Worse than any year in the 1966 to 1982 bear market, where one literally had less money 16 years later? Yep, it was worse. Was it worse than 1987? The stock market crash? Yep, last year was worse. Worse than any year included within the internet bubble bursting? Absolutely not even close. All right, gotcha now. How about worse than 2008? You say no way, but yes it was. How can that be? In 2008, the S&P lost almost 40%. The bond market was up substantially in 2008. Last year, we experienced the double whammy of the S&P being down 19.5% and bonds being down more than 13%, which was the worst performance for the bond index in the history of this country. Put that into context, the second worst year was during the Civil War. Most of you recognize over the past 10 years that we've started to consider fixed annuities in place of bond funds in many instances. Many have heard me in the past explain why I believe bond funds are the worst invention of this industry that I love so much. If interest rates stay the same or go down, bond funds will work for you just fine, right in line with what they're expected to do. Well, if interest rates go up, not so much. 10 years ago, we were in the early innings of a new experience for everyone. Rates being kept to near zero in many parts of the world below zero. A very risky proposition for holding bond funds. In all my videos and newsletters in 2021, I was expressing my deeply held belief that inflation was an issue and rates were bound to rise, impacting both stocks and bonds. Let me give you a comparison of what we were able to do for our clients. If in 2020 you purchased a 5-year fixed annuity, you probably would have been able to lock in about 2.75% per year. All right, so for the past 3 years, 2022 today, you have gotten 2.75% per year for 3 years. Compounding, you would have about 8.48%. Let's say 3 years ago, you were investing in a bond fund, let's say the bond index ETF or the bond index itself, which is exactly what a majority of my peers do. The 3-year return for the bond index was a negative 5.21% per year. Compound that for 3 years, that's a negative 16.46%. Comparing the positive almost 8.5 to the negative almost 16.5, that's a whisker shy of a 25% differential on bond investing over a 3-year time period. Well, what's happened since? The industry started to act. From 2021 through 2022, fixed annuities sales increased by 66%. From Q1 of 2022 to Q1 2023, fixed annuity sales increased 157%. Either one can say, better late than ever. I'd be more prone to say, you just skated to where the puck was and the other team has already scored. I don't have such an idea for you today, but I am interested in talking about the economics of a very scary world and what I see.
After 2022, looking to both the near and long term, what insights can you share for our clients?
So Danielle, you ask on the market front. From a market perspective, the consumers are still actively buying, which does cover up a lot of the warts that has had so many so concerned, for let's just say the last 12 months, and when is this impending recession? I'm going to first start on the pros. Artificial intelligence. Can it make the U.S. more productive? Well, let's hope so. In the past 3 years, the U.S. worker has been as unproductive as any time in history. Back to the good news. I feel very confident it will. It ain't going to happen overnight, but it will act as a small tailwind for years to come. and will have a positive impact on GDP growth. Not as important, in my opinion, maybe to the internet, but important all the same. Also, never count out American ingenuity and the lack of fear of getting our hands dirty. Now to the cons. Geopolitical issues, and although I did mention the robust American consumer above, they're finally running out of excess cash built up in 2020 through early 2022. Delinquencies on credit card and car loans are all rising. School loan payments have restarted, not to mention the cost of housing. I mentioned credit cards and auto loan delinquencies. When I look at them, they look very similar to the way they normally react as you're entering potentially a recession. How steep that recession is, that is really not for us to be able to. We could guess, but that would never be anything more than that at this point in time. So many other variables will come into play. But I guess what I am saying is, I believe a slowdown is inevitable, okay? That should have somewhat of a positive impact for bonds under normal circumstances. What do I mean by that? So if I'm going to project out to the future, this is sort of a unique point in time that one or two things I want to see investors doing, and how that's going to impact our return long term, is how do we take advantage of these higher rates? One of two ways. You can lock in today and get 5.5%, if not maybe even more, in certain investments that we certainly can discuss too on a one-on-one basis. Also, things that I don't do a lot of. There are going to be components of the bond market that maybe over the next 10 years do 6 or 7%, whether it's lowering interest rates that juice the return a little bit, or it's upon taking a little bit excess return. That leads back to the 60-40 concept. This is something you need and want to be interested in. I'd love to be able to sit here today and say, over the last 40 years, the 60-40 portfolio has made close to 10% per year. I can say that because it has. What I can't say is there any legitimate opportunity to be able to replicate that in the future. But if we sit here today, and I'd be extremely happy, and this is, if you were to put me on the spot and say, what will stocks do based upon their valuations today for the next 20, 30 years? I have to sit here today and say, it ain't going to do the 10% of the past, but it has a very reasonable expectation, if not a full expectation, that 8 is probably where I would see it going. When it comes to bonds though, bonds is not a prognostication. It has so much to do with where rates are at your starting point. So if we're talking today and say rates are 5, 5.5, then very reasonably we should be sitting here and saying, I should be able to get 3.5 to 6% on my bonds for the next 20 years. So say one puts 60% of their money in an asset getting 8%. That's 4.8 per year. Say you took 40% and put it to a bond getting 4%. Okay? Right. That portion of the contribution to my investing would be 1.6. All right? That equals 6.4. So if I have to sit here today and say, what's a 60-40 investor going to do for the next 20 years, which is what we really all care about, I think it's reasonable that we should be expecting in that range. Now, as you all know, when we do projections, we project significantly lower than that.
Matt, considering my very short investing experience, it seems that I should just invest my money in large cap growth stocks like Tesla or Facebook and be set for my retirement. What are your thoughts?
Thanks, Danielle. There is a big difference between being a speculator and an investor. Speculators look to take advantage of short-term, what's hot now trading trends in hopes of hitting it big. Think Bitcoin, GameStop, AMC, or maybe even mega cap stocks so far this year. Investors, on the other hand, look to make money by following long established market patterns that use data to support said patterns. Today, I don't want to get into the discussion about speculation, but instead the idea of keeping the investor's long-term mindset during times when short-term patterns seem to persist. If I were to ask you the question, what's the best performing style of the market over the last 50 years, what would you say? What about the last 100 years? If you took a poll, I bet many would answer, well, large cap US stocks, of course. That is actually not the case. If we take a look at the historical data being shown on your screen, you will see that U.S. large cap stocks have, yes, in fact, been the best performing style over the past 10 years. However, it may surprise some of you to see that on a historical basis, U.S. small cap stocks are actually the best performing style of the market. What does this mean for us today? We are by no means saying that U.S. small cap stocks are posed to start outperforming the broader market. What we are saying is that people fall victim to the idea that what is hot now will always remain the top dog. And as Rob said, we want to be where the puck is going, not where it has already been. This is especially true of the trend that we've seen year to date. A group of stocks, also known as the Big Seven, which are mega cap stocks, think Apple, Facebook, Amazon, Netflix, Nvidia, have been the popular picks this year. But if we look at them from a valuation standpoint, we can see that they're extremely overvalued. PE ratio, or stock price divided by earnings, is a common valuation metric used within our industry to determine what companies are overvalued and what companies are undervalued. Those Big Seven have an average PE ratio of around 40, while the rest of the entire S&P 500 have an average PE ratio of just 15. Sure, we've been able to take advantage of the large cap mega stock trend over the last 10 years and more recently year to date, and our clients have certainly enjoyed nice returns because of it. However, we are not fooled into thinking this trend will last forever. If we pause and review the current valuations in the market, we will see that these mega cap stocks and growth stocks in general are overvalued versus their historic norm, as I mentioned. While other areas of the market, such as small cap stocks and even international stocks, remain fairly valued, if not undervalued versus their historic norm. We here at DLAC have a very structured approach to how we invest our clients' money. We take into account valuations, buying low and selling high, economic conditions, what areas of the market do well under certain economic environments, and more importantly at the end, momentum. What things are hot now can sometimes remain that way, and vice versa. Things that are cold can continue to drop on their way down. All three of these components are essential to great money management. The key is to find the cheap areas of the market that we believe are posed to outperform given the current economic conditions, while at the same time waiting to invest in those positions until they have some positive momentum. Leaving out any of these factors, especially momentum, could leave you grossly ill-positioned and could cost you significant returns.
Jason, I understand you have a couple of updates to share with our clients, one of which is very exciting, and the other is, well, a bit less exciting.
Thanks, Danielle. Given the choice, I think I'll start with the least exciting update. Recently, the SEC has made it a regulatory priority, to monitor texting between clients and financial advisors. We, of course, will comply with the SEC's demands, but it will require that each person at DLAC get a new cell phone number that is for texting only. You'll receive an email later in the year laying out all the details, and as always, you can reach out to us and we'll walk you through the process and make it as seamless as possible. Now, on the exciting front, we have recently been given the capability to help clients manage their investments in their employer-sponsored retirement plans. Many Americans that are not retired and many clients of DLAC have a great deal of wealth in their 401k or their 403b plan. We're excited that this new capability will allow us to make specific recommendations individualized to your situation. And we'll still be limited by the funds that are available, the menu of funds that are offered through your retirement plan. But we're excited about the capability to be able to provide customized advice on what, for a lot of people, is their most valuable retirement asset. We look forward to talking to you about this in upcoming meetings.
Thanks, Jason. Yeah, absolutely. If appropriate, we'll bring it up to you in meetings. Once again, I just want to wish everybody a very happy holidays from everybody here at DLAC. Thank you.
Thank you for joining us. And from all of us here at DLAC Wealth Advisors, we hope you have a great holiday season.